Hey everyone, it's a pleasure to be here. Quick bio to introduce myself. I'm actually one of the transatlantic people here, so was born, educated, and raised in France. I did a startup in the financial services market in Paris. And after its acquisition by Reuters, I did a bunch of things for them. And then 23 years ago, I moved to the Valley to become a VC. And almost 20 years ago, I started a firm. At the time, it was called SoftTech VC. Now it's Encore Capital, which was essentially one of the very first seed firms in Silicon Valley. And in 2007, I raised one of the first seed fund in history. And those are some of the companies that I backed over the years. So I'm here to give you a bit of a market update on what happened so far in VC land. It's not pretty, so don't mean to discourage you, but the numbers are the numbers. Essentially, it's all going downhill. The good news is AI, is a bit of a shining place, and there's a lot of excess in AI today. But there's basically been a deceleration over the last 3 quarters. You'll see the numbers in terms of VC investment. So it's kind of, it's not going super well there. Exit markets have been tepid. I'm sure you kind of got that from the IPO sort of session. A bit of a uptick in Q3, but really not that much. Selling software is extremely challenging, as companies of all sizes will, cut back on people, on budgets, and so our companies really suffer on that. And it's kind of the most challenging fundraising and execution environment I've seen in my 23 years as a VC. So let's drill into the numbers. Essentially, and sorry about the wrap-up, that shouldn't happen. Investing in the US is essentially back to 2018, 2019 levels. We still, we don't know what's going to happen in Q4, but I assume we're going to have roughly the same numbers as Q2 and Q3, $37 billion. And so as you can see, we'll be roughly at $160-ish billion invested. It's a lot of capital, right? I'll give you that. And when we were back in 18 or 19, we were actually pretty happy with the levels of investments that we were investing. It's just really different from the craze that we had in 21 and 22, where essentially each year we've been going down about 30%, right? 21 was 30% less than, 22 was 30% less than 21, and probably 23 will be less, 30% less than 22. What's really stunning is the number of deals, right? Almost 19,000 in 21 will probably not even hit 10,000 this year. So that means less dollars invested and in many less companies. If you look at the quarter-over-quarter numbers, it's actually sort of even less. Or more visible across different stages, whether you go super early stage at seed, where I invest, mid-stage Series B, growth stage, it's all the same. Some of you are not based here. You may be interested in what's happening in the global markets. It's kind of the same, right? You can see the trends. The US is always about half of the global market kind of number, and it's the case again. You were at 125 billion so far versus 247 billion invested globally. Numbers would look much, much worse without AI. Preqin has reported that they have measured $73 billion so far this year, invested in about 3,600 deals. That's massive, right? It's not surprising. OpenAI raised $10 billion from Microsoft earlier this year. Just a few days ago, we heard about this company, Anthropic, raising $4 billion from Amazon and then $2 billion from Google. And it's very common to hear about billion-dollar rounds that go to LLMs because they require a lot of cash to be trained. That means that even though it's kind of impossible to extract the numbers of actual AI companies from the numbers I shared, it's kind of logical to see about 25 to 30% of the investments so far this year going to AI type companies, which is incredible. If you go into the different stages, same thing. There's a bit of a blip in the Series C and D sort of numbers. It could very well be some AI companies having raised, but every sector has gone down. And I can see from my own vantage point that at seed, there's just much less going on. We at Encore typically do 3 or 4 investments per quarter. We've only done 1 for the last 3 quarters. US valuations are kind of ticking down. And by the way, I have 10 minutes for my talk, Paul. I have 10 minutes for my talk, not 13, not 20. So US valuations are ticking down-ish. So this is a logarithmic scale of this year's median valuations versus last year. And you can see sort of a bit of a drop, maybe 10, 15%, but certainly not what you would expect given the drop in markets. Carta sort of says actually something slightly different. Obviously, it's a subset of the market. And they have seen valuations actually going back up a little bit. Certainly seen them going down. This is a shocking sort of number. 12 months trailing valuations, multiples. 2 years ago, 13x, now 5x. Just think about that compression of 2.5x happening in just a couple of years. So even though in private markets we're kind of decorrelated from the public, this is hurting everyone trying to raise capital at this point. If you recall what happened in 21, there was a ton of activity of crossover funds, and the SPAC market was super active. Crossover funds, barely not really a blip because you're still investing about $10 billion a quarter, but certainly not to the extent that they had a couple of years ago. And then SPACs are almost nowhere to be seen. The number is so little that it barely prints. Why? Well, because the SPACs that have happened in 21, 22 have basically sort of been a freaking disaster. And so today, it's very challenging for a SPAC to actually raise and then go find companies to try and accelerate the transition from private to public, because that's really what a SPAC was about. Mentioned that. Exits, very little activity. Just see the difference between 21 and 23 so far, 50 billion. Only glimmer of hope, and we'll talk about this with my panelists, is there's been a bit of activity on the exit in Q3. So at least it's not as bad as Q1 or Q2, but no one knows whether we're going to have more happening in Q4, or whether it will be just it just happens to be a few deals that happened in Q3. And here you see where exits happened, and you can see the IPOs over the past couple of years, not even really being kind of an interesting number. VCs last year raised a record sort of amount from LPs, and that was actually surprising given that we were starting this trend of having issues with valuations and market being going down, so on and so forth. And this year, this is sort of catching up with us. And this chart shows you how much established VCs, so funds that have raised more, firms that have raised more than 4 funds versus emerging managers have been doing. And essentially, the compression happens for both, right? You could assume that emerging managers have a harder time to raise than established ones, but no, it's not the case. And what's interesting when you look at global numbers is that US managers are actually suffering more than their European and Asian colleagues. As you can see, the shrinkage in fundraising is actually sort of happening in the US more than anywhere else. There's a shocking number that I didn't know about. So Preqin says 7,600 firms globally. That's a lot, obviously. about 60 to 100 are actually raising capital right now. And so far this year, only 800 have closed anything. So that's a word of hurt for a lot of our colleagues. At the same time, we have just a shocking overhang in the US, $300 billion that is available to VCs to invest. So it's not like they can't raise. They've raised the cash. They can invest it. They just don't move and don't invest. So a couple of thoughts. We have a super uncertain economic outlook. Wars everywhere, uncertain political climate in the US. And so the big question that I have and we have is, when are things going to improve? We were hoping for the second half of 23, not going to happen. So we're hoping for 24, we just don't know. We'll talk about this with my panelists, but the key for startups is figuring out how to balance runway, so how much time do you have before you run out of cash and need to raise your next round, and growth, which is necessary to raise your next round. The problem is finding the right balance. You can't, run out of cash too fast, otherwise you'll be in big trouble, because raising in this environment is really hard. That's essentially, what we'll talk about in the next 25 minutes. It's super hard to raise, and what's uncertain is what are the hurdles that companies need to achieve in order to get one of those VCs to open their checkbook today. So that's it for this, this quick presentation. Good luck, because we'll need some. And yeah, the goal wasn't to get them to leave and go cry.